Welcome to Galaxy Brains.
An infinite amount of cash.
I'm your host, Alex Thorn.
The U.S. banking system is sound and resilient.
Bitcoin made a new all-time high.
If you're not long, you're short.
Satoshi's going to come on there, laugh hysterically, go quiet. All Bitcoin's going to be erased.
Bitcoin's the best crypto asset.
Bitcoin is going to zero.
Welcome back to Galaxy Brains. As always, I'm your host, Alex Thorn, head of firm-wide research at Galaxy. Bitcoin not zero, and we have a great episode for you this week. James Check from checkonchain is our guest. He's back. We've talked to James twice before. James is one of the preeminent on-chain Bitcoin analysts. We're going to talk with James at length about where we are in the Bitcoin cycle, if the latest pullback is just a dip or if it portends some forthcoming deeper pullback or even bear market. James and I talk a lot about Bitcoin's maturity, the amount of demand that is sopping up a fairly large amount of supply that's being distributed, and what else the on-chain data tells us about the state of the Bitcoin market. We'll also check with our good friend Beimnet Abebe from Galaxy Trading. We talk with Bim a lot about Jackson Hole, what the Fed's commentary on employment, focusing on employment versus focusing on tampering inflation, means for rates and the economy going forward. And of course, we'll talk about Bitcoin and Ether markets with Beimnet. And before we get to all of that, I need to remind you to please refer to the link to the disclaimer in the podcast notes and note that none of the information in this podcast constitutes investment advice or an offer, recommendation, or solicitation by Galaxy or any of its affiliates to buy or sell any securities. Sorry about taking last week off. I was on vacation. I just simply could not make it happen. As our podcast handle said, I did drop my microphone in a tidal pool. Sorry, Phineas, you're going to have to order me a new one for when I'm not in the office. Thanks for sticking around, and let's get right into this great episode. Let's go now to our friend, Beimnet Abebe from Galaxy Trading. As always, Beimnet, welcome back to Galaxy Brains.
Thanks for having me.
So, gosh, I mean, I was on vacation last week, so there was no episode. The last episode we did, Bitcoin was at all-time highs. It was at, I think over my shoulder, it was 123 or 124. The story looks a lot different at the moment. We're at 111. I mean, you know, it's still kind of just the range, but it's kind of funny because we were at 108 in January. So right now, as we talk, Bitcoin's just sideways all year, almost no gain at all. All of that, and Ether has come back from its new all-time high, which it did hit last week again. Sort of, what is the genesis of this pullback? And it had happened in stocks as well, but stocks have since rebounded.
Yeah, I mean, I think basically Bitcoin is losing out in the attention economy at this point in time. You know, ETH has kind of overtaken it on a volume basis and on a handful of days certainly from a mind share perspective, just because it's gone from 1,500 at the lows to 4,600 as we're filming this, and when things move up in a straight line and there's a figurehead that's like charismatic and people are paying attention to it, it really grabs a lot of attention. So I think you've seen a meaningful rotation away from Bitcoin into ETH. Point one. Point two, we've seen a significant amount of whale selling on BTC. There's one prominent whale that's been selling BTC and buying ETH in particular as well.
On Hyperliquid. Yeah.
On Hyperliquid.
Yeah.
And so, you're seeing a lot of profit taking in BTC from folks that have held BTC for a very long time. Mm-hmm. And then in terms of the retail interest, like you see it now, like the ETF inflows for Bitcoin are much more muted relative to ETH in particular.
Beaten it.
Correct.
Not just on a market cap weighted basis, but
on an outright dollar term basis.
And several weeks now.
And it has to do with the prominence of digital asset treasury vehicles, right? Prior to the sell-off and basically for the majority of the last 2 years, the most notable buyer in the space was MicroStrategy. And MicroStrategy has been acquiring fewer and fewer Bitcoin over the past couple of months because they've had a change in kind of their policy, as well as, their premium has declined.
Right.
Versus, with ETH, you've got, SharpLink, Bitmine, and they've accumulated a ton of ETH.
I think Bitminer, Tom Lee's vehicle, has more than 2% of all ETH already.
Yeah, I think
in a short amount of time.
Correct.
So enormous amounts of buying.
Enormous amounts of buying. Now the question is how sustainable that is, and it's sustainable to the extent that price keeps going up for the most
Yeah,
part.
it feels almost like the classic cyclicality finally kind of happening, where Bitcoin leads the way, eventually ETH steps up.
Yeah.
And if it plays out, and it doesn't mean that like the whole cycle will degrade, but sometimes these are intra-cycle, intra-coin cyclicality. You could see, 2017 Bitcoin all-time high, early 2018 Ether all-time high. In March, like altcoin all-time high, right? Like that could end up being what's happening from the rotational standpoint.
It might be, but I will note that there are like serious things happening in crypto simultaneously that are kind of adjacent to like these token appreciation. Like Google had the announcement yesterday,
L1.
their own L1. You've had Hyperliquid, right? They're generating almost like a third of all like revenue on chain.
Yep.
And that's trading at all-time highs.
Yep.
You had JP Morgan announcement yesterday, partnership with Numer AI, I believe it's called.
An AI
Numerai.
trading
Yeah.
algo type firm.
Yeah. And so you're
Numerai.
Numerai.
I guess.
And you've had like a bunch of like stablecoin and payments related headlines as well. And so the progress towards making crypto the preeminent infrastructure play for traditional markets and the traditional world, like we're making significant strides each day.
Not to mention tokenization
And yeah,
all
exactly.
that type of stuff. Yeah.
But again, like, this is where I struggle. It doesn't necessarily mean that tokens like are worth more.
Right. Right.
And so like that's kind of the tension in the market. But right now you've got a good flywheel where, these digital asset trust companies are trading at premiums. They're selling stock to willing investors and are then buying, spot, which is causing, price to go up.
Yeah, and I think even in Bitcoin too, it's like people have been. It's funny, like there's a lot of malaise about price action. Like I said, it's almost flat.
Yeah.
Year to date at this point.
No.
But Bitcoin, year over year is up more than 50% still, right? It's been a big run, and it doesn't mean it's over. I don't believe it is. I'm still calling for higher by the end of the year. But I want to pivot to, we can talk about that more. I mean, and we will over the coming weeks, obviously. But there was other huge news that I know you want to talk about, which was the Fed's meeting in Jackson Hole last week.
Yes.
And I guess the headline that drove a lot of action and drove stocks to all-time highs was that the Fed is, abandoning the language of its 2% target? Are they actually, is that right? And also, was it just the language, or are they actually abandoning the policy of their 2% inflation target?
Well, the way I would frame it is, simply put, they are much more concerned about the risks around the labor market, so much so that they're willing to forego their inflation objective.
So right now they're willing to try to spur the labor market more than
Try
they
to
want.
prevent additional weakness in the labor market.
Then beat down the risk of inflation with keeping rates higher.
Correct. Now, I think this is a major policy error by the Fed. Everything we've seen so far suggests that pricing pressures are not only here, but that they're persistent in key sectors of the economy, including services, which is by far the largest portion of the U.S. economy.
And
but
housing too, right?
Everything. Housing prices are at all-time highs.
Right, and lowering rates.
And asset prices are at all-time highs, right? And lowering rates is not going to improve the mortgage market.
Right, it's going to make it more competitive, right?
It's going to, well, no, the back end of the market is responsible for setting mortgage rates, because mortgage rates typically have a duration profile that's very long. And so what the market reaction to the Fed lowering front-end interest rates is going to be is, like they're not that serious about tackling inflation.
So higher long end.
The back end should move higher in response to a perceived policy error by the Fed. But you just have to think through the figures that we're seeing, right? You're talking about core PCE estimated to come in at 0.3% month on month, which is like it's like 3.5% annualized. And you still haven't felt the effects of the tariffs. PPI surprised to the upside, right? It came in at a 0.4 month on month. Import prices also, surprised higher. And then you're seeing things like abroad where like Chinese export prices have finally started to rise as well. And so, we're at this juncture where inflation is elevated, still super elevated, and we haven't seen the full effect of the tariff policy.
It could go higher.
Right? And so you're telling me, oh, yeah, the job numbers, we were bad at calculating them, so they came in really light. Okay, great. That's the past. What do we know about the future? The future entails almost like a $1 trillion plus of capex that's going to go into the economy over the next like 12 to 14 months, right? That is a ton of build out, in energy sector, in semiconductor, in construction jobs, right? So I've got, one of the guys I talked to, he's estimating an additional pickup of around 75,000 jobs per month from the capex that's been announced.
For data centers, AI,
Correct.
All that type of stuff?
Right?
So you're saying supportive of a better labor market.
A much better labor market. And then you still haven't felt the full effects of the big, beautiful bill. Like, it is a massive bill. You're talking
massive spending bill.
Massive spending bill. And so that will also create jobs.
And push inflation higher.
Correct.
So you're saying, and also the data on jobs, just to be clear, there were revisions, and there was the scary report like 2 months ago where it was like, oh, wait a second, the only jobs being added are like in-home care, right? Which is scary. But still, the top line employment numbers also don't look that bad at the moment,
4.2%
right?
4.2% unemployment
So
rate.
they don't look bad. They could get better.
Yeah.
And some of the factors that might make them look better also push inflation higher. And this is why you're saying a policy error, you think?
Policy. And then you also have the fact that we have a new BLS head, and Trump wants higher job numbers.
I think the job numbers will, even if they're not lower, they might look lower.
But it's such a tricky dynamic. But what people have to realize is that, when the genie comes out of the bottle with inflation, there are economies that have been desperately trying to quell inflation for the better part of decades.
Yeah.
Right? And once that genie's out of the bottle, like the medicine for it is one that's not palpable in the current economic society or political society. It's just not palatable for people. And so when you move too early as the Fed, you're risking something much greater, which is like a loss of confidence in your ability to maintain price stability. Right. And so I just think we're being a little naive and succumbing to, political pressures, whatever it may be, by being like, oh, inflation mandate. Nah, that's not as concerning as the job stuff right now.
If you picked one of the two mandates, promoting employment or maximum employment or whatever, and price stability, in my mind, price stability is the one of the two that the Fed has a better chance of impacting with base rates.
Correct.
Right? Way more
Correct.
Government policy and other things go into whether or not people have jobs than just what the overnight interest rate is. Right?
Correct.
So it's like they're also using their tool on the thing that it's worse. They're prioritizing its use on the goal that they're worse at solving with it.
Correct.
Right? Like they have a better chance at keeping inflation down than they do promoting employment using rates. So
I completely agree with you.
What do you think? Is it political pressure?
I mean, it's a bunch of things, and there are folks that are respected economists at the Fed that are perceiving the data a little differently than other members, and I totally respect that point of view. But you can't tell me that inflation hasn't been above target for the better part of the entirety of 4 years. Right. And the consequences of runaway inflation impact every American, employed or unemployed. Right. If wages don't keep up, inflation is a tax on the consumer. And it's a runaway train a lot of times. And so that's why you're seeing things like gold, continuing to trade well, all-time highs.
Yeah, and then gold didn't have a DATCO run because that's some of what's just coming off here with Bitcoin too. Is just the exuberance of, it sounds problematic and troubling.
Yeah, it's problematic and troubling, but again, it's just there's too many folks that I think have such a short-sighted view of markets, right? Even Powell, to a certain extent, his term runs out in 6 months or less. I think it's like 5 months.
I think it's like May of next year or something like that,
yeah,
right?
yeah.
So that's
So
like 8 months.
and then you've got the president that's focused on these 4 years, and you've got Congress on 2-year cycles and senators on 6 years. Like, it's just like, guys, like, I would like to be 55 years old and a home not cost $10 million for an entry level home.
Right.
Like, can we address that?
Yeah. Well, I don't think we can. It doesn't seem like we can.
We don't have the will to.
We do not have the will.
I will tell you, we have tackled aggressive inflation before in the past.
You're thinking about
Look,
Paul Volcker?
Paul Volcker.
Yeah.
Right? Jacked up interest rates.
Really high.
Really?
Like 20% or something,
like
right?
18 or 16. But like, he beat inflation. It's possible.
Yeah. Have you ever seen that image? I think Joe Weisenthal posted this, but it's of a mountain range in Wyoming, and it happens to look just like the 70s and 80s inflation, or what, maybe rates. Yeah.
What we need in markets is Paul Volcker-esque courage to do what's hard. Not
Powell has said that Volcker is his idol. Maybe he's tired. He looked tired. I mean, and it's not literally tired, but I mean, in some photos, he looked in Jackson Hole like, gosh, man, I've been doing this a long time, exhausted.
Yeah.
It's been an exhausting
again,
run.
To your criticism, of the Fed, which I totally respect, by the way, like, we did make a policy error by having policy way too easy for way too long during COVID.
That's right.
Right? And if you had raised rates much sooner and constricted the economy, like, maybe we wouldn't have as much of an inflation problem right now. And so, but at the same time, you could pass blame to Congress as well. Like, you sent out helicopter money. What do you think that's going to do?
Oh, yeah. And even now I saw Trump is talking about more possibility of more helicopter money, that some of the funds earned from tariffs could get rebated to Americans. Surely they could just not do the tariffs and let us keep the money in the first place, from our goods not going up. But anyway, that doesn't have the same headlines. He likes to put his names on the checks. Right? Didn't he sign them himself or something the last time during COVID? Or you had like his,
I'm sure.
There was something like that.
But
It said like from
realistically, you
President Trump.
understand that it just gets wired into your account.
I know.
But anyway.
That's true. I didn't get it. Yeah.
If you did get a check,
I think
it's
it was
based on
just
your
if you
tax
pay
returns.
taxes. Yeah.
Yeah, and it's based on
Yeah, maybe if you mailed your tax return
correct.
in,
You might have gotten
then
a
you got a
check.
physical check. But
Yeah.
most of us just ACH it or whatever.
Yeah.
All right. Well, we'll keep following it. My friend Beimnet Abebe from Galaxy Trading. Thank you so much.
Thanks for having me.
Let's go now to our guest, James Check from checkonchain. James, welcome back to Galaxy Brains.
Thanks for having me on, Alex. Always good to be on Galaxy Brains.
Thank you so much for coming. And I always love to have you on sort of at the as we're having or when major market moves or shifts in sentiment are happening. We talked once, I think back in April of this year, while we were both, maybe you had just gotten to Bedford and I was yet to arrive. And then also we talked last year, sort of right towards the end of chop solidation, I think maybe in September. And so we've been talking about this, and this feels like an incredibly apt time to talk to you. You've been writing, as you always have, but prolifically about this sort of latest move. Now, people should remember we hit an all-time high of almost 125K just less than 2 weeks ago, or about 2 weeks ago. But since then, sentiment has degraded significantly. With Bitcoin trading at like 110, as low as in the 109s, but around 109, 112K as we record this on Wednesday, August 27th, around 112K. And people are incredibly bearish. How would you characterize, before we get into why, we're going to talk to you a lot about your take on the cycle and all of that, but how would you characterize how people are feeling? Because it seems incredibly bearish out there.
It is. It's a really interesting dynamic because when we talk about major market moves and sentiment shifting stuff, we're 10% below a fresh all-time high. This has been one of the key things that's interested me so much is watching the social narrative and then kind of looking at the data. And, we'll talk about why this particular pullback, I think, may have a bit more energy to it. But at the same time, it's more flat, but it's flat over a year-to-date period. Let's anchor to the 1st of January. But now let's go a 12-month view. Oh, suddenly you're up, 60, 70, 80%. So it's one of those things where I think just people's lens is kind of changed by how sideways this market has been. And it's not really recognizing that the drawdowns are 10%, 20%. I was marking out a chart yesterday. to just try and say, like, if we were to have a drawdown like 2024, if we were to have a drawdown like 2025, and I put like a little pin on my chart to show like how deep we would have to go, and then overlay some price models to kind of see how we line up. And it's like, wow, we really haven't pulled back this cycle at all. And I'm using the hourly chart too. So I'm trying to get like wick to wick. And I'm like, if we go to 100K, that's like a nasty correction this cycle. So it's a very interesting dynamic. I think there's also a lot of people who've been somewhat trapped by Bitcoin's performance, which has been tremendous all cycle. And until very, very recently, ETH has really not performed. So I think a lot of people were kind of trapped on that side of the leg. And I can only imagine a lot of people rotated out at the bottom, and then the pain of watching something that you used to own or wanted to own ripping to the upside when you could have been there is actually worse than taking an L. I think a lot of people got caught up in the treasury company hype, and those have compressed. They've grown their balance, but the stock tickers got crushed. So I think a lot of people have just held the wrong thing. That's a big part of it, but also just there's a lot of sideways price action. And my kind of base case, I think sophisticated market actors kind of understand that you look at the price chart, you go, guys, it's a monthly macro scale uptrend with very few pullbacks. But then folks who are kind of going, but I'm not rich enough yet, they're kind of stuck in that world where it's like, but Bitcoin was promised to go up 100x. It's like, yeah, but it's also $2 trillion. So just getting those kind of expectations aligned, I think, has been a bit of a challenge for people.
Yeah, I agree. And the pullbacks, we had some pretty much more substantial, really several pullbacks last year during that chop solidation. We did have this giant pullback from over 100K to like 75K in April, when everything, the sort of, what do they call it? Independence
Like the tariff
Day.
tantrum.
Yeah, Trump's tariff tantrum. And Bitcoin rallied hard off that, like a V-shaped recovery. And Ether didn't, right? Or did eventually, but Ether had gotten so low. And I love that you make this point, because we're seeing this in some of the flows in general, that there is rotation into ETH right now from Bitcoin. It almost feels a little bit like a 2017, early 2018, where like some gains appear to have been taken to bring us down from 125 in Bitcoin, and possibly been rotated into ETH. And you're right. I think for Bitcoiners watching what has been about a 3x move from Ether just since April, hurts when Bitcoin only kind of like went up, it only went up 50% or 60% back to its all-time high, and then can't hold it. Like I think that's part of it as well, is the people are dancing on the grave of ETH in April. And then they've had this bullish narrative with people like Tom Lee seeming to have more of an impact on ETH than Michael Saylor and David Bailey are having on Bitcoin, right? And sort of like, that's not fair, or I don't know. But I would remind people, when it comes to Ether, that was building off a very low base, right? Like that thing had gotten destroyed over.
And the other thing to think about is that Bitcoin really did a lot of the lifting. Like it kind of elevated the value of sats, and ETH is still significantly below its merge price in BTC terms. So it's still, if you were to really take an honest view, there's a very, very high potential we just have another lower high here on a macro scale. So it's, there's that element. And whilst I'm not yet there, and we can talk about this more, I'm not quite there to draw a direct comparison here. The last time I saw this specific event happening where ETH just ran was in May 2021. Bitcoin's peaked, come off its high. Suddenly everyone goes, that's it, let's go. Alt season, ETH rallies. Next thing you know, everything's down 50%. And I don't think we're going to have that kind of an event, but it is not the kind of stuff you see at bear market bottoms. It's the kind of stuff you see later in the cycle.
Yeah, and I use the 17 Bitcoin all-time high, and then Jan 18 ETH all-time high. It's probably a bad example, because that would imply that it was the end of the cycle, and I don't think I see a lot of evidence of that. But it does look like sort of some intra-cycle rotation a little bit, also contributing to both Ether's rise and Bitcoin malaise here. But let's step back. Let's talk about, you wrote a great piece about wondering, is this pullback a dip, or is it some perhaps portending of a broader pullback, or even the beginning of a bear market? You had a couple key takeaways. Generally, I think if I summarize, you're saying we're not yet at the level where you have to consider it to be more than a dip. What makes you think that?
Yeah, there's a few different angles here. And I think the first one to start with is, I often describe, just to simplify everything, you've got the demand accelerator and you've got the sell side brakes. And we're very lucky in Bitcoin where we can see both of those, how depressed those pedals are across many, many lenses. And this is a whole topic to itself, but there has just been an extraordinary amount of sell side this cycle. Hodlers, OGs, whales, all sorts of entities. You just see this consistent pattern where the market is rallying and old coins come back to life. Coin days get destroyed, profits get taken. You just see these volumes. And people can debate how much of it is actually sell side. It seems to happen every time the market goes up. And when it happens too much, the market stops going up. So, we can just draw a very simple cause and effect. So that's the sell side breaks. That's been pretty significant, although this rally, as you said, from April up until now, there has been meaningful sell side, but it's a fraction, 30% or so of what we saw in November and March last year. So the sell side hasn't been as high, and actually it's tapering off. And there's an idea I've been floating around. There's almost this like symbiosis between hodlers and the Bitcoin price. They know when they have the capacity to sell. It's when the market's ripping, demand's coming, ETFs are there, sailors there. A lot of these whales, they will distribute when that demand is there. When it backs off, they actually tend to back off their sell side. There is this very interesting dynamic there. So on the demand front, the ETFs have slowed down meaningfully. As you mentioned, the ETH ETFs have been taking in multi-billion flows. Bitcoin's been having some outflows. It's been a real softening over recent weeks. So the ETFs have been a main driver, and they have been much, much softer. The other one is the treasury companies. So I've been thinking about the ETFs as like a consistent passive bid, and it has really performed that way so far, certainly in 2025. The treasury companies have been this kind of aggressive buy as much as you can bid, but is totally dependent on their MNAV premium staying high. And they have been compressing quite sharply across the board. So suddenly you just don't have as much treasury company buying. And I also think the treasury company buying has been overstated. A lot of people are looking at bitcointreasuries.net, which shout out to NVK, great website, super useful. However, when new treasury companies are added, or for example, I won't call out specific names, but there are some that, take the Bitcoin that's already on X's balance sheet and they put it on Y's balance sheet. And there's like swap of coin for share agreements and all this stuff. Like it's not actually new buying. So people can overstate the actual bid side that's been there. Sailor, no question. But really, once you get outside Sailor, it's not huge in terms of the overall demand profile. So, it's growing, but it's also compressing. So your demand accelerator is coming off significantly, but so are your sell side breaks. And if you've got both your feet flat to the floor, the car goes nowhere. If you take both off at the same time, the car kind of also goes nowhere. And that's very much the dynamic that I see that we're in.
Yeah, I think that's right. And you have seen significant whale selling. This is one point that some people on X and in social media, I would say in a conspiratorial manner, sort of refuse to acknowledge, despite the fact that you and others have been pointing this out. There are claims that the price is being suppressed artificially, manipulated. Things like paper Bitcoin, which is also kind of funny because the Vibes Capital Management guys like to joke about paper Bitcoin summer. They're talking about the treasury companies, but the old idea used to be some sort of form of derivative-based manipulations, like
there's
selling
also FTX. They don't actually have the coins, and Sailor's only got sheets of paper.
Exactly, selling coins that don't exist. We talked about that on your prior appearance about the sort of false double top in 21 possibly being caused by FTX. There was very low network activity then. So maybe it was artificial, perhaps created by like FTX artificial paper Bitcoin. But again, the sell side volume, how has it compared? Or maybe, thinking about like old coins coming online, like how has it compared to prior cycles?
Oh, it's this cycle is massive. Like the dollar terms, in dollar terms, the amount of sell side pressure we have seen this cycle is extraordinary. For a bit of a sense of scale, when we look at the realized value of every coin, so take every coin in the supply and price stamp it when that UTXO was created. So when did the coin last move on chain? Satoshis are worth 0. The guy who bought the 2018 bottom's worth 3,000. I've got a bunch of heat maps to kind of show how this evolves over time. There's a bunch of guys down there who bought the FTX bottom, and that's still a really dense supply zone. If you look at the USD value of all of the coins in the supply, 60% has a cost basis above $90,000.
Wow.
So when you actually think about what that means, like Bitcoin is 90K plus. That is when people have their, call it recency bias. It's literally where they've invested their cash. Yes, there's going to be exchanges that have moved coins there. And yes, there's going to be ETFs that have moved coins there. But the point is, that is where the last coins have moved. That's where people's anchoring bias is. And when we talk about sentiment, This is actually a really key. This is, like we mentioned before, how do I try and distinguish between a dip and a more serious bear market? We can look at when coins go in and out of profit because we can see their cost basis. So in aggregate, we can see how much of the supply is underwater and how much of it is in profit. Long-term holders right now are sitting on about 1.3 trillion with a T of unrealized paper profit, right? And if they all sold their coins tomorrow, obviously they wouldn't get that out, but the idea is that's how much, that's a big buffer. It's kind of difficult to be too upset when like 95, 98% of your portfolio is significantly up and the last $1,000 you put in is down. So generally speaking, we look at the ratio between, or a comparison between paper profit, and this is not paper in the paper Bitcoin summer sense, unrealized profit versus unrealized losses. And if you compare those two, how bad are the losses? How bad is it? So right now, short-term holders, about half of their supply is underwater at about 108K. That's their short-term cost basis, 109K. Generally speaking, when we go below that level, it's actually quite normal for bull markets, certainly this bull market, but it's also the point when short-term holder sentiment just takes a bit of a punch because suddenly more than 50% of their coins are underwater and their unrealized losses start to increase. However, in our current dip, the price really has to go significantly down into that 100K, 90K. You've got to get that huge demand cluster, that 60% of all of the dollars invested. You not only have to get that underwater, but you've got to get meaningfully below it because people being down 5%, they don't really care that much about 5%. They don't really care about 10%. Once you're down 30%, now it starts to impact you. Oh, maybe I should just wait for the next. Or actually, this dip feels kind of no good. So there's this dynamic of like where sentiment is. And from an unrealized loss perspective, you kind of have to put a microscope on the chart to actually see how small it is. It's really irrelevant. It's not even remotely close to what we've seen in 24 and 25. Prices got to get down to about 90K before we start getting to like your typical 2023 plus cycle dip. So the damage just isn't there yet. And you know, I use the Crocodile Dundee meme where it's like, that's not a dip, right? This is a dip. It gets significantly worse before I get too concerned. So as you said, cautious bull, certainly looking at things saying, look, it has the potential to deteriorate, but here's some key thresholds. We got to get below 109K because until you do that, like it's still a bullish trend. The odds are, I think we may probably test that and give it a bit of a, but then we've got to see whether that 100 to 90 to 110K zone, massive, absolutely massive demand cluster. It's been demand in the past. I think a lot of people are going to see it as demand in the future. And therefore, it kind of sets up a very simple framework. We should find support in that zone. If we don't, then suddenly you've got all those people who are going to flip into a loss. And now you may actually have a more protracted bear market type problem. And then you start thinking about how far can you go below there? And, you know, it's not about predicting the future. It's about trying to understand where are those tipping points for human sentiment.
Yeah. And I think from my perspective, we kind of tested that post-election high as support in April of like 74, 75. And so that's where I would always be looking post. It's so funny though, because the sentiment right now seems almost more bearish than when we dumped to 75.
Totally. Yeah.
Which
it's
is
wild.
just,
I
really
honestly
is
think it's
psychology.
because people have been crushed in treasury companies. I think that's a big part of it. People have just not got the performance they expected just because of NAV compression. A lot of these companies literally have more Bitcoin and yet their stock price is sideways and probably down, which is, it's tough.
Yeah, I mean, some headlines I see today. 1 in 3 Bitcoin treasuries slip below value as, quote, spiral of doom fears grow. That was a headline yesterday. I saw a headline today in Bloomberg, Strategy's Bitcoin strategy falls on its face, right? So, like, there is negative reporting. It is clear, too, like, and that's obviously, you know, I think then, like you said, the actual prices of the stocks, you know, have languished a bit. I mean, MicroStrategy's not made new all-time highs since after the election. And you have these others, there's a lot of them too. There's so many of them.
And if you want my if let's just say, right, I love to play in scenarios because in markets you have to. Let's say we're in a bear market right now, and you start thinking about, okay, well, how low does it go? We start breaking through 110. Next thing you know, we're at 100. Things start to cascade. People have to cash in their loans. You can kind of see this all playing out. What is the most beautiful, perfect headline that's going to hammer out a bottom? I don't think it's down 80%. I'm struggling to see how Bitcoin goes down to 20K, 30K, 40. Like, good luck with that.
Yeah.
So therefore, you're like, okay, well, how deep is a modern bear? Let's just ideate what a bear could be. right now, the average inflow cost basis for the ETF, so it's kind of our best estimate of where the cost base is, 78K. What's Michael Saylor's cost basis? 74K. What's the average cost basis for everybody on chain? It's about 77K. So, and no matter which way you want to slice and dice this, all the headlines of, Michael Saylor soon to be liquidated, BlackRock investors get wrecked, like just name it. That like 75 to 80K zone is just absolutely perfect. And you've got the top of the chop, which is that 24 zone of accumulation. And that would be about a $1.5 trillion asset in terms of market cap. Now, I can't bring myself to believe anything in markets can happen. So this is not saying it can't happen, but a $1 trillion market cap is 50K thereabouts. Bitcoin's $1 trillion asset. Like, I'm sorry, I'm going to bid that thing all day, and I'm sure there's a lot of people out there who will. Bitcoin, if we go down below 50K, like it is. For me, I'm all in, because at that point in time, well, I'm all in already, but more all in. 50K, like it's $1 trillion asset now. It's got to go higher than that.
Yeah, I'm not. I agree with you. I like the convergence there, and like you said, the accumulation zone. That's the post-election level. That's also the April independent tariff tantrum level. And if we go down $35,000 from here, which puts us around 75K, that's only a 31% decline.
That's what I mean. When you overlay the worst possible correction, you're like, is that it? Is that it?
Yeah,
like,
I think but it's funny. It's like I don't know. It's hard to put yourself in the shoes of last year. The chop solidation was pretty rough for people. The mental, but we kind of
time pain. It
was time pain. This kind of feels like that, because we opened the year at what, like 108 or 100. I mean, actually at Sailor's party, which I was at. Were you at that party? I can't remember.
No. He should come over to Australia. Make it easy.
Well,
for me.
Somebody was joking, is he going to have another 100K party if we test it to the downside? It was a great party, by the way. But that we were actually sub 100K. So we actually opened the year in like the mid 90s. And so we're up a cool 10% from there, or more, 15%, right? Right now at this moment, which, by the way, is pretty good. But people.
And if you extend the clock back to 12 months, it's up like 60%. It's like, that's pretty damn good. Actually, when you think about it.
Yeah, it is. People, I don't know what people think. Do you think does it get harder? You sort of alluded to this, but it gets harder to go higher the higher you get, right? Totally. I mean, it's a bigger asset.
It is. And you just simply need bigger flows. But at the same time, we've also got bigger flows. And Bitcoin has always done this. As it grows up, you get larger and larger entities and institutions starting to come in. Starts with your libertarians, starts with retail, starts to move on to your hedge funds. Now we're moving into the world where we've got pension funds and sovereign nation states now. They have large balance sheets, and they also are fairly price insensitive. They're just willing to accumulate because they view it as a long-term asset, but they also move much slower. And that's why whenever I look at the sell side story, a lot of people think like, hang on, sell side's bearish. It's like, yeah, but for every seller, there's a buyer. We're measuring demand by proxy. And if you look at the ETFs, they're about, by my estimation, about 20 to 25% of the demand profile. If you just look at how much the realized cap changes over time, you compare that to the ETF flows, it's about right. We occasionally get, and actually it's been a key factor here is things like the CME arbitrage, where they'll buy the ETF, they'll short the futures. Very often you'll see ETF inflows and outflows very much correlate with changes in CME open interest. Not all of it is cash and carry, but a pretty meaningful chunk is. Those premiums have compressed. They're like, last I checked, it was like 6% or 8% or something. And they used to be 12. So, suddenly you're talking about a couple of 2% above your risk-free rate. And suddenly it's not really worth it. There's other rates out there that people can get. Yeah. And I've also been looking at Saylor's preferreds. I think Saylor's preferreds, because they are this kind of yield curve type dynamic, and there's all different ones. Like Strike, for example, is now trading below its $100 face value, $95 or whatever. Strike is these are representations of how likely the market thinks he's going to pay the coupons. Because if he's going to pay the coupons, then they're probably going to be worth something. Stride, which is the optional coupon, is down below its IPO price, means that the market's starting to sense maybe he's not going to be able to pay this coupon. He might have to put it into the icebox for a while. Strike has like an embedded, what do I think MSTR is going to do? If MSTR is not going to do very well, and that's the market's view, then he's not going to be able to use the ATM as aggressively. Suddenly you can start seeing that it actually is a really nice price signal when his preferreds aren't doing great. When they're trading below that $100 face value, it's suggesting that the market goes forward looking. I don't think you're going to be able to pay these coupons the way that you've said you would. And that's like an almost forward view on where Bitcoin's going to be. So I think there's all of these signals just saying like it's probably going to be a little bit softer on the road ahead, but also it's got to get a whole lot worse before it's like true bear market potential.
Yeah, I think that makes a lot of sense. Another thing I wanted to ask you about is how people are going to position. I don't know if you think about macro, you're more of an on-chain guy, but like, for example, last week we had in Jackson Hole this sort of, it's hard to characterize. The way Beimnet on my team and on this podcast characterizes it is not that they gave up the 2% target, but that they have publicly said they're more concerned at the moment about labor than they are about inflation. And that is what's going to lead to cutting. Stocks have basically made an all-time high since then. But Bitcoin languishing, is it secular Bitcoin? Is it it's just inside? Do you think that we're getting the double-edged sword? You alluded to this about the treasury companies not delivering these wild upside that maybe some thought they would. Like, is it inside the Bitcoin market, or do you think it's part of any kind of change in the long-term view, specifically as it relates to macro?
This is a great question, and I would consider myself a macro tourist. I love studying it, and I often I actually listen to most of my analysis consumption is macro in the economy. What I don't have is the ability to just pull charts and stats and give the actual numbers. So I very much what's the right word? I vibe analyze macro, right? I've got my gut feel and my thesis. In the long term, I think Lynn Alden's dead right. Nothing stops this train. I think in the immediate term, there's a couple of, I'm going to call them orange flags. I've read a couple of posts, and again, I'm not going to opine. I'm no expert on equities or AI or any of this stuff. But gut feel, when I looked at the treasury company, I was like, yeah, I think the gravity is that MNAV goes to 1. And then I've tested that idea, and it seems to have played out. I just had this gut feel that we're investing a lot of money in AI data centers and chips. And I've used AI. I would not say I'm a prolific user. I prefer, for all my analysis and my work, I like to actually use my brain because that's actually the fun part for me. So I don't use it for any of my writing or my videos or my charts. I use it to maybe do some of my actual code in the background faster, which is very much programmatic. But even then, it's 80% there. A lot of the time I have to turn it off because it just makes edits that I don't want. And suddenly I hit tab and it's broken something in my code somewhere. I certainly don't use it for copy. And I just look at my own usage of it. I'm like, it's okay. That's kind of where I'm at. It's okay. And I also know that the revenue models don't work. And I love the analogy to Bitcoin mining. Bitcoin mining is a CapEx and OpEx heavy industry. And then you're producing a commodity that you don't control the price of and is volatile. If you look at what AI is doing, it's even more CapEx intensive because the chips only have a use by date of 2 years before they're outdated. Sometimes they're outdated by the time they've even built the facilities. These chips are moving so quickly and they're so expensive, and you're charging $20 a month. I don't know, man. I don't know if this kind of CapEx cycle can continue. And then you look at the stock indexes, and Nvidia is the stock index. So if Nvidia, and by the way, Nvidia's customers are the other part of the stock index. So if any of this slows down, suddenly the whole thing can turn quickly. So I think I would summarize a lot of this as fragility. The Japanese bond yields just keep going high. If you look at that chart, it looks like a shitcoin coming off the bottom, right? It's a tremendous, tremendous chart in terms of Japanese yields. And there's just so many things. I'm like, what if? What if tariffs start to bite? What if you just get a slowdown from all these things? What if Nvidia doesn't have the sales that they think? And there's just layer upon layer of it's just concentrated risk. So my base case is that Bitcoin, I actually think, is far more powerful as a global index than people realize. I think people are slowly coming around to it. Something happens on a Sunday, you better believe your favorite gold bug is posting a Bitcoin chart because he thinks that that's going to, look how shit Bitcoin is. No, that's what your equity portfolio is going to do on Monday morning, sir. That's what's going to happen there. So I think Bitcoin is really a global index. And I look at this slowdown and the demand coming off. Ultimately, why does the Bitcoin price go up? Because people are buying it, people aren't selling it. At this environment, we're not getting people buying it. Why aren't people buying it? Maybe they're actually concerned about other stuff. So that's one way that I like to look at it. I just think it's got that global index factor that I may not understand all of the AI stuff, and I don't spend any time studying it, but I'm feels like a bit of a slowdown as told through the lens of Bitcoiners.
Sam Altman even recently used the word bubble in describing the sense of it. I happen to think we we need a lot more build. But I agree. There have been some studies. I think MIT put out an interesting study I saw reporting about that some large percentage of companies that they had surveyed that had done pilots with AI to gain productivity, like 95% of those projects did not result in more productivity. So there's definitely, I think, some fragility. And it's fair. I think humans, I mean, Bitcoin's been through this many times as well. Like humans get really interested in an important new idea that oftentimes is real. You take the, internet bubble in the early 2000s, right? In the late 90s, like that was real. We did
Super useful.
Pets.com was a great idea, it turns out. Now it's mostly Amazon, but like, I mean, these things that were bubble-ish ended up the bubble occurred because people were rightly excited about a big new idea, and it's sort of a timing and an exuberance question, not a fundamental question. I think that's the case with AI as well.
And things get commoditized, and I think AI is very much a commoditized system, right? It's just a race to the bottom with a high capex cost, which Bitcoin mining isn't, to be fair, because it's a race to the bottom in the mining sense, but the asset tends to go higher. Whereas in, you got to keep charging people less because people are less able to pay because of inflation and cost of living and all that, and people will just move. So I think it's a commoditization challenge.
All right, so sort of a final question here, James, and you've covered a lot, by the way. I encourage people to listen again to what James said about 15 minutes ago. We won't repeat it, but I wanted to ask you about it, which was sort of your criteria for when to become concerned about moving lower. I think that's one of the more important things we discussed here. But sort of like, I was asking myself this in Vegas at the conference, the Bitcoin conference. Are we at the end of the beginning with Bitcoin or the beginning of the end game with Bitcoin? And I don't know the answer, but it feels, said another way, it feels a bit to me like we're sort of entering Bitcoin's second or third act, that the early days are surely over. Now, we may still be early in terms of where we ultimately end up, but this is not the Bitcoin market of, your libertarian friends or even your friends and family from the last two cycles, right? There's something, you're talking about big, giant demand and big, giant sellers. Where would you peg us in the long-term maturity of Bitcoin as an asset, James?
I think that's about right. And I've had a handful of circumstances recently where I've actually been able to orange pill friends and family somewhere because they came to me. I rarely kind of push it in there anymore. I've done my time with that. I'll wait for you to come to me. If you've got questions, I've got all day.
Yeah.
So I've actually had more luck with people who are talking about, man, cost of living here and the economy there, and this doesn't make sense, and all our politicians are monkeys and they don't know what they're doing. I'm like, yeah, this is the reason. Like maybe it might be because, global trade, blah, blah, blah. And they're like, oh, interesting. And then I often find that I say, this is why gold and Bitcoin are just going to do so well. And you lead with gold and they go, yeah, okay, I understand that. And they go, tell me more about that Bitcoin thing. That's interesting. So I've had more of that success, which to me it no longer is the immediate, it's a scam. We've passed a big chunk of that. This is on the retail side.
Mm-hmm.
On the institutional side, I mean, it's just, I'm sorry, you can't have tens of billions of dollars being sold on a regular basis without institutional capital. We're not talking about, retail pocket money anymore. This is serious money. This is why the drawdowns aren't as big. The volatility capture strategies that are in there is why we get a lot of this sideways price action, right? Options are growing. And actually, this is a really important point. If you look at the ETFs, at all of the ETF complex, since January, if you take away IBIT, ETF flows are flat. They've gone nowhere.
Yeah.
And when did that start to diverge? And suddenly IBIT is the market for ETFs around November. What happened in November? The options went live. So this is really showing, going back to that paper Bitcoin idea, I actually wrote a piece called Paper Bitcoin where I said, guys, without derivatives that are deep, liquid, and massive, you can't have big institutions putting in serious capital because they need to be able to hedge their risk. And we're actually seeing IBIT just tear away 57% by AUM now in terms of dominance. That is the scale of the maturation. So
and I think the regulators did just approve like a 10x increase in outstanding contracts for IBIT.
Is that right? I mean, it's just going to keep exploding higher.
Exactly. So, and it is way ahead in the derivatives game there for sure.
Yes. So in terms of the macro cycle, I actually view it in three. I think there's been three approximate cycles. 2017 was the first end of the like early adopter, retail only, barely had trading view, spot, a handful of shitcoins. There really wasn't it was Bitcoin. It was a Bitcoin market. And also key to note, Bitcoin was the casino chip you needed to bet on altcoins on Binance. So it was the casino chip. There was that middle period between 2018 and 22 when FTX blew up. So the 2017 top through to FTX. Believers in Bitcoin could see the future and go, I think this is where it's going. And this was my formative years in 2019, really onwards. That era was believers plus leverage plus just boom and bust. We had the collapse of 2018. We had the Ponzi scheme in 2019. We had March 2020, stimulus, and then we had FTX and everything blowing up in 22. It was just straight up and straight down. Mm-hmm. And since then, we've just got this much more cyclical, structured. I mean, the price chart looks different. Every oscillator you want to look at, whether it's MVRVs, which is on-chain, you can look at price in the 200-day. Those two breaks, there's a clear shift in the regime of how the market trades. So I do think we're at that phase where it's beyond a household name. It's starting to get that 0.1% to 1% to 2% portfolio allocation. People don't think it's a scam anymore. We've flushed out all of the degenerate leverage. We've still got a couple of Ponzi adjacent games being played left, right, and center, but that's part of the. I mean, the whole world's Ponzi adjacent. Let's face it. Let's not kid ourselves. The whole fiat world is Ponzi adjacent. This is just our take on it with treasury companies and the like. So, it's a fascinating point in Bitcoin's history.
Well, there you go, James Check, my friend. Thank you so much from checkonchain. Check out James as Checkmatey on X and checkonchain.com. Thank you, James. That's it for this week's episode of Galaxy Brains. Thank you to our guest, James Check from checkonchain, and our friend Beimnet Abebe from Galaxy Trading. As always, everyone have a safe and happy week, and we will see you next week. Thanks for listening to Galaxy Brains, the weekly podcast from Galaxy Research. If you enjoy the show, please like, rate, review, and subscribe wherever you get your podcasts. To follow Galaxy Research, sign up for our weekly newsletter at gdr.email, read our content at galaxy.com/research, and follow us on Twitter at GLXY Research. See you next week.